Let's get more on perhaps how some of those big risks could potentially impact portfolios going forward. And for that, Geoff Wood from Morphic Asset Management is joining us from our Sydney CBD studio. Geoff, Eurasia, boy, it's a pretty depressing litany of concerns that they have as potential risks for 2018. I guess what would sort of be topping your list as far as risks as we head into this new year?
Yeah, hi and Happy New Year. Thanks for having me. I'd first of all start off with a comment that we're starting 2018 ultimately with the most constructive backdrop we've had post-GFC, where both China, Europe and North America all surprised to the upside economically last year. And we had good earnings growth globally that have supported stock markets. So we've got to keep that in mind, but nevertheless, it's very important to know what can go wrong at any one point in time and keep an open mind to those. So I'd say number one would be a risk around China policy. At the moment, they're going to have another go at trying to deleverage the system and lower credit growth, and that ultimately means higher interest rates in China and more controlled bank lending. And they've done a relatively good job in the past around this. They're pretty savvy operators, but if they were to go too far on that, then we could see a sort of more sharply slowing Chinese economy, which would have global ramifications, especially for places like Australia and the iron ore market.
Okay, so that's your top risk. Yep. Do you have that in the very likely basket, or are you, as you alluded to, confident that China will negotiate this economic transition successfully?
It's not in the very likely basket, but it is likely, and it could actually happen.
Okay, so that's a big concern for us here in Australia,
exactly.
No doubt.
Yeah.
We then, though, can contrast that against a strengthening U.S. economy. I mean, we've had a U.S. Fed that was confident enough to raise rates 3 times in the past year. Looks like they're on path for 3 or 4, potentially, in 2018. What could go wrong there? I mean, is it the pace of tightening that concerns you?
Well, I think the thing to bear in mind with monetary policy is it takes around about 18 months, so it operates with a lag. So the term I'd say is that those hikes are all in the post. I mean, we've had 4 hikes in the last 12 months roughly, and so you could argue that they haven't yet hit the US system. So we'll be closely watching the Q1 and Q2 data for any signs of disruptions on sort of consumer confidence or consumer spending, but you could certainly argue that the market's a bit complacent. They've seen these hikes go through and they're going, oh, nothing's happened, everything's fine, it's going to be okay for the Fed to keep going. But I'd say this is sort of the core point where you do want to be alert to see if we see some impacts from those.
Is it also, I mean, the U.S. Central Bank, you have to think of, is cognizant of the fact that those rate hikes do take time to work through the system, but is perhaps the X factor as well, the fact that they're winding back this massive bond buying program, QE, all of this monetary stimulus is also coming out of the system?
Absolutely. I mean, that's a good point. So you've got the QE tapering, we've got tapering in Europe at the same time. So there are a few sort of monetary policy levers at work right at the moment that are operating behind the scenes here.
And to what extent do you think that rising oil prices could also potentially dampen the U.S. economic recovery, which, sentiment, optimism riding high right now in the wake of that tax overhaul, and with the promise of infrastructure spending coming from the U.S. president and the federal government there. But we've got rising oil prices, and notoriously in the U.S., that works to dampen consumer confidence.
Exactly, and it dampens spending. I mean, it comes directly out of people's bottom line. It's not a discretionary item. People can't sort of cut back on their oil spending. And it's up around about 30% in the last 6 months. So typically you'd see that as something to be cautious about. But I think the way the market's looking at the moment is, from today onwards, your US consumer is getting a 2 to 3% tax cut. So people are more focused on that side of the individual's balance sheet at the moment.
Okay, before we are at risk of becoming Too negative. You did start by saying all three major regions of the world surprised to the upside in 2017. We do have a looming Italian election in March, but all of the doomsday scenarios that we had starting 2017 when it came to the election cycle in Europe didn't come to fruition. So again, I know that you're invested in Europe and European companies. I mean, how are you sort of reading that scene?
Yeah, we had the French election last year where Macron, was up against Le Pen, and the market saw that as a big signal that perhaps it had got too one-sided in its risks around Europe. Euro rallied from 105 to 120, and Euro Swiss rallied, and now we're at the sort of top end of some of these ranges, especially in Euro Swiss, for example, which is a good proxy of risk appetite around the European breakup. So I'd say that this is a risk that's not that well priced at the moment. We're starting to see Italian bonds, they've started the year by selling off, so we're getting some repricing there. But it wouldn't take much, you can imagine, in February, where if the polls are starting to look like the five-star party there, the sort of breakup party are gaining momentum, then we could be back talking about what we've been talking about for the last 5-7 years, which is European breakup.
Geoff, so putting all that and wrapping it into a bow, where are you at Morphic looking to invest on the global scene then in 2018? Where are you looking to gain exposure?
Well, at the moment, our main overweight is around Japan. We like Japan. We like the structural setup there. We think there's still some cheap stocks on a relative scale. So that's the market we're most keen on adding to at the moment.
Geoff Wood, Morphic Funds Management, thank you so much for joining us. Speak soon.
Thanks very much.